not for the next period, not for the previous period. So if we paid rent in advance for 6 months, from 6th of the June, not 6, from 6 months, starting from September to next year, March. And your accounting year ends on 31st of December. You paid 6,000 yuan, right? So how much you will record this expense? So when you reach here on 31st of December, you will record the amount of rent that you used. How much you used out of this 6,000? 300. September, October, November, December. Sorry, 4 months. Then it would be a 7 months. January, February, March. Yes, 7 months. That would be a 7,000. And the 3,000, can you record it on income statement? Answer is no. This will go to income statement of, for example, this is 2020. This is income statement of 2020. And this would be belong to 2021, right? And since you are here, so you did not consume that, that would be your prepaid expense. And prepaid expenses are our assets. We record it on balance sheet, right? So here we go. This illustration illustrate the expense recognition, sometimes referred to as matching principle. So here we go. In our example here, so recognize the expense of a period against revenue earned during the period. So net income, how we calculate that? Revenue for the period minus expenses for the period, 2,000. Right? So if, do we have that illustration here or not? No, I think no. Then just remember this one. Only recognize all those revenues that belongs to that period. Similarly, when we do some questions, it will clarify our ambiguity. Now the third one, adjust the accounts. What do we mean by adjust the accounts? So adjusting entries or adjusting the accounts, these are journal entries made to ensure that revenues and expenses are recognized in proper accounting period. So generally made at the end of the accounting period. Here we go. So include at least one income statement and one balance sheet. So normally the entries like that, in two accounts, one belong to balance sheet, one belong to income statement, can be credit or debit depending on the situation here. So which accounts need to be updated? So we have a trial balance, which is just coming after you close down the balances. We call this unadjusted trial balance. So in the solution I showed you regarding trial balance, that is unadjusted trial balance. Why? Because we do not cater the unearned revenue services and other the prepaid expenses over there. So let's talk about that. What does it mean by this? So we call the adjustment entries or adjustment of the accounts into three categories. One called deferrals, second called depreciation, third is called accruals. What do we mean by deferrals? Deferrals means deferred, which means what you can defer. Definitely you can defer the payment. You want to delay the payments, not receive the payment. Everybody wants that you receive the payments as early as possible. So deferral constitute of the payments of an item or receipts of cash in advance. So the deferrals are prepaid expenses or unearned revenue. Unearned revenue or prepaid expenses. Understand? Do I need to repeat what is prepaid and what is unearned revenue? I think we will be discussing in our next slides. So the next one is depreciation. Depreciation. Here we go. Why we cannot move? The depreciation, I think, here we go. The depreciation allocates the cost of the plant asset to expenses over the asset's useful life. Basically, it is the wear and tear of the asset or the allocation of all the cost of the asset towards its useful period. So we'll talk about this as well. Accruals. The accrual is the opposite of the deferral. For example, for an accrued expense, the company records the expense before paying cash. It means accrual mean you can just remember this one as a hint, occurred. So expense occurred but not paid, right? So we call this accrued expense. For accrued revenue, the company records the revenue before collecting cash. So accrued revenue is the revenue or the sales that happened, but customer says we'll pay you later. Deferred sales are that customer pay you in advance and you need to deliver later. We call this unearned revenue, right? So if you're still confused, let's do this one by one. First of all, prepaid expenses. So what do we mean by prepaid expenses? An expense paid in advance. Yes.
Deferral?
Yes, they are a category of deferrals, but we see that one by one. Prepaid expense means that you paid in advance. It means cash payments before cash recognition. Right here. Why I cannot use my pen here? That is a totally tragedy here. Oh, yes, I cannot use that. Why? Okay, I'm using my. Here we go. So the prepayments are rent, insurance, supplies, advertising. So let's talk about this. What do we mean by the rent? That we prepaid rent in advance for 2 or 3 months or 1 year. Insurance, that you pay the premium, that anything can happen, then you will compensate me, but it has a premium. So you cover yourself for the whole year. Supplies, you have supplies. For example, in case of papers for printers, you have markers, you have all the office supplies, the glue, the sticky notes, all those stuff. So when we use that become expense, right? Advertising, you pay for advertising and it will run for whole year, right? So these categories are called prepaid expenses. So let's talk about this. Prepaid rent illustration. Suppose Freddy's Auto Service Incorporation prepays 3 months store rent, which is 3,000 on the June 1. The entry for the prepayment for the 3 months is going to be, because you pay cash is going to decrease, and prepaid rent going to be increased. So how is going to be recorded? Here we go. Prepaid rent Increased, you write it down on the debit side. Cash decrease, you write it down on the credit side. Any question?
Nope.
Nope. Okay, now, throughout the June, what happened? Throughout the June, prepaid rent carries the balance of 3,000. At June 30, you need an adjustment entry. Why? Because you consume 1 month, June. That becomes your expense. So that asset that you made for this month in advance, 1,000, that becomes now your expense. So entry would be rent expense to the assets which you increase prepaid. So prepaid rent going to be decreased and expense, which is rent expense, going to be increased. So entry would be rent expense to prepaid rent. Understand? So you see the posting here, the prepaid balance is now left 2,000. 1,000 go to the expense for the June. So remember the recognition principle. So this expense belongs to the June, so it should be recorded in June. Recorded in June. Everyone understand that, or should I need to repeat? Sipade, David, Jordan.
Yes, sir, I got it.
Yes, I got it, sir. I got it.
Good.
Yeah, no question.
And now we talk about supplies. On June 2, Freddy's Auto Service paid cash 700 for cleaning supplies. So he purchased cleaning supplies of 700, right? Supplies to cash, simple. You see, it's the same, the concept is the same for T account as well. Now, what happened? At June 30, it indicates that 400 of supplies remain on hand. So you purchase 700, 400 is on hand. How much we consume?
300.
300, well done. So this 300 belongs to June as an expense. So expense gonna increase and the supplies, which is our assets, gonna decrease. So the entry gonna be supplies expense to supplies. It is expense, so we name as supplies so that we can segregate that this belongs to this, right? Theoretically, it should be only expense, but we added to clarify as because this belongs to supplies, because company has other expenses, salaries expense, wage expense, advertising expense. So we need to clarify it so that the managers or financial analysts, those who want to find out different ratios, so they know that what is the rent, how much this business costs at the rent, so blah blah blah, so that they have different segregation. So we segregate here. So you see here, so through posting, you see balance left 400. So this indicates you the balance left in supplies account, and we are confirming that 700 supplies we purchased on 30th